real excited this morning to have Dr. Bob Pozen with us. And our relationship with Bob started a while back, thanks to Alex Boyle in the Harvard Business School. And Bob was fortunate enough to come and talk to us about this book, Extreme Productivity. If you haven't bought or read it, I encourage you to do so. It's his latest product, and it's a really fascinating book. But today's topic is going to be corporate tax and strengthening our economic security. Let me talk a little bit about ASP for a second, and then I'll lay out some ground rules, and I'll let you have the floor. The American Security Project funded and started in 2004-2005 by Senators Kerry, Hart, Hagel, and Rudman. And the intent was to take issues that were topical, related to national security, but when brought up, oftentimes got painted in a political slant one way or the other. For instance, climate change or nuclear security, just to name two, energy security. So their thought was to put a board together of equal number of Republicans, Democrats, businessmen and women, and then add 8 flag officers. Flag officers meaning admirals and generals, 3- and 4-star, retired, who felt strongly about each one of those issues, particularly from a national security perspective, not at all from a political perspective. So from that point, we were able to take all these issues and run with them ever since. In the last couple of years, we've taken on American competitiveness, and a lot of that's thanks to Alex Boyle, who's a dear friend of ours. We did a paper 2 years ago on American competitiveness and listed about 10 categories where we thought America was really slipping competitive-wise. Alex happened to read the paper, and he saw that it was coincident with a survey done by the Harvard Business School in 2011 and 12, in subsequent years, on the exact same subject, but they surveyed all their alumni. And when you looked at the 10 or so topics that they had come up that America needed to improve on, they coincided almost exactly with the 10 that we had. And corporate tax reform was pretty close to the top of both of those. And so hence, we started doing a little more homework and figured out that Dr. Pozen is an expert in this realm, and I'm sure you're familiar with his biography. He teaches, of course, at Harvard. He's a senior fellow at Brookings. Extensive experience in the finance industry, and it's going to be a pleasure hearing from him this morning. What I'd like to do for starters is just do a quick around the room and just a quick introduction as to who you are first, and then I'll lay out some ground. Yeah, Alex. This is Alex Boyle.
Retired banker.
Retired banker.
Port Rockaway, that's for you.
Maddie Bush, intern here at ASP.
And this is Maddie's last day with us, Maddie.
Miguel Morita, the Ministry of Finance and Superintendent.
Super.
Paul Hummel with ASD. David Dalton with ASD. Matthew Wallen, fellow here at ASD.
Jordan DeVoe, video nurse.
George.
Ryan McKinnon with Senator Mike Lee.
Great. Thanks for coming.
Joel Churches with the Treasury Department.
Super.
Mohammed Keshki with the Resource Group, a holding company in the business services industry.
Great.
Andrew Holland, senior fellow here at ASD.
I didn't mean to cut you out in the back.
Oh, no, Ted Cohn, I'm just a visitor.
Ted, thanks for coming. What we're going to do today is I'm going to let Bob speak for a while, and then we'll kind of have a conversation back and forth with everybody here about this particular topic. We are going to record it on that camera up there, and I realize it's a small, tidy group, but that's a good thing because we all get to participate. The real advantage here is we put them all up on our website. We've been averaging 20 or 30,000 plus hits a month, maybe more. And my fear is a lot of people go, oh, I'll see it on the website tomorrow, so I won't show up today. But it'll be on the website tomorrow, so everything is on the record. And with that, I'm going to turn it over to Bob.
Well, thanks all for coming, and I encourage you to, at any point, ask a question or make a comment. I want to make this as interactive as possible. And I think, when I was asked to speak about corporate tax reform here 2 months ago, it was hot topic then, and now, if anything, it's even hotter with Pfizer's bid for AstraZeneca. This is just, I think, a dramatic illustration of how dysfunctional the system is, that we see large companies going to great lengths to get out of the current system. So I'd like to do 3 things. One is briefly explain how the current system works. Some of you may know it, some may not. Second of all, talk about the main proposals that are on the table and why I don't think that they're really well designed. And then third of all, talk about a proposal that I have that I published in the Wall Street Journal in February, and then recently in Fortune Online. So let me begin with the first part. I mean, basically, we have a very counterproductive system. You might say, if somebody thought, well, let's see, how can we design the U.S. system for taxation of foreign profits of multinational corporations in the way that would be least productive to the country and to the multinationals? We might actually choose this one. This would be high up there. Why is it? Well, we have a combination of a high statutory rate, 35%, which often doesn't bite in the U.S., but it does in this case. When you bring it back, you go pay 35% minus your foreign tax credits, but then we allow you to have essentially indefinite, permanent deferral. In fact, to keep that tax liability off your balance sheet, you have to sign a paper to your auditor saying you're not bringing it back. So what's the result? Not surprisingly, we have over $2 trillion in cash and cash equivalents sitting overseas by U.S. multinationals. And the only places where it's really being brought back are from places like Japan, which has a 33% rate, and so the differential is only 2%. But UK's average rate is down to 21%, Ireland's about 12%, Singapore is at 7%, and Cayman's is at 0. Those are important numbers to keep in mind, because what's happening is some of the smartest people in the world, that is international tax lawyers, are using their very big brains to figure out how to relocate all of these profits as much as they can to Ireland, Singapore, and the Caymans. So I would say my rough estimates are that the average tax rate on foreign profits of U.S. multinationals that's being paid now is about 9%. And that's because they don't pay it back to the U.S. and they've managed to bring it to low-cost jurisdictions. The practical effect on the U.S. economy is really bad. This $2 trillion cannot, one, be used to build U.S. facilities. Two, cannot be used to buy U.S. companies or U.S. technology. And three, cannot even be used to pay dividends to U.S. shareholders. And that's why we see what most people would think of as a really crazy phenomenon where Apple goes in and borrows $17 billion, even though it has $130 billion in cash, because that money is not available. So if you think about American security, American economic development, that is the biggest piece of money that is not helping the U.S. And the more we keep the current system, the more money, it's sort of a downward spiral, because then more money gets invested overseas, more money gets made there. And so you have these things like inversions. And inversion is something that became popular in 2001. People used to have companies, U.S. companies used to merge into a shell abroad. And then Congress decided, no, you can't do that, and they put a lot of penalties on it. Now there are several requirements, 3 important ones. One is, if you merge into a foreign company, your shareholders have to come out with less than 80%. So in a case like Pfizer, that means they got to buy a big company. That's why they're big buying AstraZeneca. Second of all, and there was finally an article about this in New York, in the Wall Street Journal a few days ago. Generally, when you have a stock-for-stock exchange, it's tax-free, but under 367D of the Internal Revenue Code, if you merge into a foreign company in what otherwise would be a tax-free reorganization, every single shareholder on the date of the acquisition is deemed to have had capital gain. They're deemed to have sold the stock. And so this will come as a shock to a lot of Pfizer shareholders to find that their unrealized gains is deemed to be taxed.
And so they're taxed on that?
They are. They're taxed on that capital gain as soon as that. So that's a big price. The company, that was the article in the journal, the company may save billions, but in fact the shareholders, all the shareholders, especially the long-time shareholders with large unrealized gains, they're going to pay a capital gain. This is part of the reforms that were put in over the last few years. The third thing is the senior officers and directors of the company pay an excise tax of 15% of all, I think it's unvested restricted shares and options. There's some very complicated rules, but that's an excise tax that's a real sticker. So to think that somebody like Pfizer is doing this is to show you how bad the current system is, because they are imposing this deemed sale on all their shareholders. They are essentially having to give up anywhere from 20 to 50% of the company. And third of all, they have this excise tax. So I'll stop there. And anybody have any questions about the current system, or any of you guys might know it?
I heard that, I don't know how accurate this is, but I heard the number reported that several thousand employees would likely move to the UK if this were to go forward. The average compensation level is about $150,000 a year average.
Well,
That's a
in order to qualify as an inversion, you have to have your headquarters abroad, and you have to at least create the facade that what you're doing is abroad. And second of all, as a practical matter, you want to move as much as you can there, because that foreign money, those foreign profits are, I mean, if you become a UK company, as you, almost every country in the world, you no longer are taxed on profits outside of the UK. So you have a tremendous incentive. You move toward what's called the territorial system. So there are two things. One is you got to move enough people there and your headquarters there and have your board meetings abroad so that the IRS considers you a real foreign company, even if you meet these three tests, you take these three penalties. And then second of all, you then are in a territorial system in which you would have every incentive to move everything out of the U.S. to as low a tax jurisdiction as you could, because you would never pay tax on it. So what would happen is if Pfizer merged with AstraZeneca, it would move its headquarters to the UK. But then it would move everything it had, research facilities, everything, to places like Singapore and Switzerland that are willing to have you pay 7% if you are willing to go there, or to Ireland at 12 or 10%. So that's the effect that it would have. It would really be, some people in England are obviously complaining about what is going to happen, or are they going to lose jobs? So there'll be some consolidation of headquarter type jobs in England. But I think the thing that people aren't talking about is, once you're a foreign company, then you're no longer subject to this worldwide tax, and you have every incentive in the world to move everything to the lowest tax jurisdictions. Other questions? Yes?
Yeah, two questions. The first one, the $2 trillion that you mentioned.
Yeah.
Are these true foreign earnings, or is there a component of that which may have been through some tax planning or whatever by these organizations, that may be money generated in the U.S. that found its way
Yeah,
abroad?
that's a good question, and the answer is that companies have become very adroit, especially in areas like intellectual property, of doing arrangements by which they transfer licenses or other IPs to abroad, and then that license generates a huge amount of profit, but a small license fee is paid back to the U.S. So we don't really, let me put this way, we know that the guy who's head of tax at all these places, or lady, is very smart, and they figured out how to do that. The Treasury has a series of rules about various types of, it's under Section 482 to try to have arm's length, but it's very, very hard to value this stuff, very hard to police it. The other thing that's relevant is a lot of these companies take the deductions here in the U.S., and then when the thing is pretty far along, they then transfer it to Ireland or Singapore or someplace, or the Caymans. So the question is, are those deductions ever recouped? And they aren't. So I would say that a large part of it is foreign profits, but X percentage, whether the percentage is 10, 20, or 30, is sort of profits that are cleverly moved out of first the U.S. and second out of main countries like Europe.
And the second question, I recall reading somewhere, I don't quite remember, maybe I misunderstood, that if a corporation's, the majority of the corporation's shareholders are U.S. shareholders, then the IRS just simply looks through any planning, I guess, of the
That's not quite true. That is not quite true. In these inversions, most of these inversions, the existing shareholder base of Pfizer will wind up anywhere between 51 and 79%. So they will be a majority But they will be a majority, wherever they're located. And they will still be an effective eversion if it meets the other rules. The other rules meaning it has to, the prior shareholders of Pfizer cannot own, essentially you have to own between 51 and 79%. Second of all, there's this capital gain. And third of all, the excise tax. But if you follow all those rules, and let's assume out of the 79% shareholding that Pfizer winds up in the merged entity, that 52% are actually U.S. residents, you're still a foreign company. That's not the criteria. Other questions? Okay, so let's talk about some of the proposals here. And, there are a whole variety of proposals, and it would be impossible to go over them all because there are so many. But I think it's useful to think of the ones that are very strongly pushed by conservatives, one by liberals, and then what I call intermediate proposals. So we have a number of corporate executives. Most recently, we had the COO, I guess, of Oracle and other people saying we need another tax holiday like we had in 2004. Tax holiday means essentially that for a period of 1 year you can bring back all your foreign profits, usually at a rate something like 6%. I think personally that has no chance of being passed for two reasons. One is if we keep having tax holidays every 10 years, we will never reform the system. It's just like an incentive to have this terrible system continue. And second of all, I think there was a lot of unhappiness about where those profits went when they came here. Some people were under the illusion that there was going to increase jobs, but there was actually no net jobs increase. And third of all, I think probably these theories, and we now have people saying, well, why don't we say it can come back if it's quote unquote used for infrastructure, maybe government bonds, maybe this. Money is fungible, and the notion of tracing it to where it actually is. If we were to say you could only use it to buy government infrastructure bonds, I don't think a lot of companies would be interested. If you said you could use it for your own infrastructure, then we'd have to figure out whether this money would have been spent for infrastructure otherwise. So it's a tax lawyer's dream, but for the rest of us, it probably wouldn't be that good a system. The second set of proposals goes on the other side, which are liberal proposals, and they are basically saying, let's go to a true worldwide system, 35%, stop this deferral stuff. And that surely would raise a lot of money, but it would make the U.S. companies very uncompetitive. If they didn't, deferral is essentially the only way that they remain competitive now. And if we were to have a 35% rate and really enforce it every year, that is, you have to pay it every year. So that would mean that, for instance, if you were in UK and you were paying 21%, you would immediately have a credit for the 21%, but you pay 35%, and so you'd wind up paying 14% difference. So that would mean that a U.S. company operating in the UK would have an effective tax rate of 35%, and they would be competing against UK companies which had 21%. So I just don't think that's a viable proposal. It may be very charming politics for somebody, but neither of these proposals, I think, work. Now, there have been a number of serious intermediate proposals that have been made, and probably the most important ones are the ones that were made by Congressman Camp, because he's head of the House Ways and Means Committee, and so therefore he's more important than the rest of us when it comes to tax, to say the least. So he has so many different variants of this, it's hard to follow them all, because there are A, B, C, and people argue D, E, and F. But we try to sort of cutting through that, think about what he's trying to do. What he's trying to do is two things. One is he's got a special, essentially higher rate without deferral on intellectual property related income, actually intangible property related income. And his theory, which I think has quite a bit of sense, and I very much respect Congressman Camp, does a very well thought out proposal, is that intangible properties can be moved easily from jurisdiction to jurisdiction, so we can't go to a pure territorial system and allow investment income, allow intangible property to be moved anywhere, because in that case, it won't just be not taxed by the US, it will all wind up in the Caymans or in Bermuda or something. So he puts a rate, and the rate is roughly 15%. So he's sort of saying that that's, you know, what's gonna happen no matter what. And the second thing is, he tends to treat what I would call active business separately, and he goes toward more or less a pure territorial system for active business. So his theory is, if you've got a real factory producing real goods and services, you should be able to put it where it is, and we shouldn't be concerned that, like IP, it's gonna wind up in Caymans, because to the best of my knowledge, I've never seen any serious manufacturing activity in Caymans. They have a lot of nice hotels, but you know, last time I was there, I wasn't overwhelmed by the manufacturing base in Caymans. So that's his basic approach. And I think there is some considerable support for it, but there are two major problems with what he does. One is he has this concept of foreign profits related to intangible rights. Now, when you look at the definition of intangible in the Internal Revenue Code, it turns out to be much broader than you think. It includes things like patents, copyrights, trademarks, but it also includes things like goodwill, customer list, etc. And the more fundamental question is, no matter how you define it, how would you disentangle the IP or intangible component of profits from other foreign profits? I mean, the fact is, in many industries, pharma, technology, high tech, these things are so intertwined that how you would allocate what is subject to this 15% and what isn't. Again, an IP litigator's dream, but for the rest of us, not such a good result. That is a problem that I think is fundamental to all his proposals. The second problem is that there is, I think, a credible argument to say that active businesses should be treated differently because they're not so easy to move around. On the other hand, if we really had a pure territorial system for active businesses, we would, I think, as a practical matter, have a worldwide bidding to take all manufacturing out of the US. Because we have seen, look, no one's going to move a manufacturing plant, as we've said, to Caymans or Bermuda, but a lot of people are prepared to go to Singapore or Switzerland. And those two jurisdictions are definitely prepared to have people come there and get tax rates 6, 7, 8% for quite a few years. Also, we know that Ireland has 12%. So what would happen is, if we could define active business and have that separate from intangible related business, a territorial system would produce much more of an outflow than you have now. Here, the constraint is that you feel like, well, if you have it over there, you can't bring it back. But essentially, what he's proposing for active business is a pure territorial system. You can put it anywhere, you make the profits, you can move it back to the US, no extra tax. So I applaud Chairman Tim for dealing, I think, really with some of these serious issues. And I have to say, I can't purport to be an expert on every variant that has come up, and there have been a lot of variants. But I do think that it has these two fundamental flaws. The other intermediate proposal you have is the Baucus proposal, which of course, who's Senator Baucus anymore? He's a guy who now speaks Chinese, so no one's really very interested in his views. But he did put together a serious proposal. I think the key flaw in his proposal is he pegged everything off as a percentage of the US statutory rate. And that's because he hoped to bring down the US statutory rate. And so he'd say, well, this is going to be, 18% of the US statutory rate. But he assumed it wouldn't be 35%. Well, that's a nice assumption, but I think it's a fair statement that it's very difficult to bring down the corporate rate on the US. And And that does lead to another big issue that I think has to be dealt with in any of these proposals. Is if the result of these proposals were to get a reasonable middle ground for multinational corporations, it's not sufficient in the sense that you're not doing anything for the small corporations in the U.S. You've got to do something with the statutory rate in the U.S. So in my view, you want to do something in the international area that essentially raises some revenue together with what I call the cats and dogs of corporate tax reform, which you could do in the U.S., and then uses that to lower the U.S. statutory rate. Remember, to go from 35 to 25% cost you $1.2 trillion over 10 years. And I'm telling you, it's
That's how much you lose.
that's how much you lose to go there.
But that doesn't include,
That doesn't include any revenue raised.
that's right.
So here's the truth. If you take out the foreign profits, people have calculated, you would actually have to close down almost every tax benefit that corporate America has today to raise that 1.2 trillion. Because that 1.2 trillion is made up of things like lower tax rate for manufacturers in the U.S., R&D credits, tax-exempt municipal bonds, accelerated depreciation. The fact is, I've never been in a room with corporate executives who are willing to give up any of that. They're all for a lower rate, but none of them are willing to give up that. Now, people talk about jet planes. That's about $6 billion over 10 years. Even the hedge fund deal where you have incentive fees taxed as capital gains, $16 billion. I mean, the problem is oil and gas depletion. The total thing is probably about 40 or 50 billion over 10 years. So unfortunately, the really big numbers are accelerated depreciation, R&D credit, manufacturing credit, tax exempt interest and bonds. Am I convincing you that they're real hard to change? So it'd be nice if you could raise some money on the foreign side. So AUKUS does the opposite. He assumes that he can reduce the U.S. rate and therefore get a more sensible foreign scheme. In my view, that's really not a feasible way to do it. He's got to come up with a foreign scheme that works and try to raise a little money through both what I call the grandfather provision and the long-term permanent solution. So I'll stop there before I give my proposals and take anybody's questions or, yes?
Is there any way that U.S. multinationals pay some of this foreign source income and reinvest it here as a new investment as opposed to a repatriated dividend?
No. The answer is, under current tax rules, absolutely not. You could, this is why you'll see some liberal Democrats saying, okay, you can bring it back if you buy infrastructure bonds, or if you build a new factory or something like that. So that's, we could create an exemption, but it doesn't exist. It doesn't exist. Yes?
Last time they did the tax holiday, it didn't create jobs, and that was 04, right?
It was 04, and there's a woman.
What was used?
Yeah, there's a woman, Kristen Forbes, who was in the White House as one of the economic advisors, now teaches with me at MIT. She's a very smart lady. It was used mainly for buybacks of stocks. That's what it was used for. And she also shows how difficult it is to put these requirements in as to what money would have been used for something anyway. It's really becomes almost a philosophical, sort of question as to how you can trace that money to particular things. Yes?
Is there any implication about what's going on with TTIP and trade and investment function?
Well,
Yes.
not only in a very indirect way, that is, to the extent that countries can offer lots of goodies to people to bring their factories there. Under WTO rules, there's some constraints on that, but for government projects, there's a separate set of rules. And so to the extent that the trade rules make it more difficult for countries to offer special deals in a discriminatory way, then that helps. But there's really nothing in the trade rules that prevents Singapore from saying, we welcome all comers at 7%. And that's, if you're prepared to put all your facilities in Singapore, they're prepared to have you at a very low rate, and they feel that they get enough from the tax rate. It's sort of like, what you ought to think about the territorial system is this way. It's sort of like the system we have in the US where, you know, when Mercedes-Benz says, I want to offer a plant, and every state in the South offers them a better deal. Whether these deals are good for the states, I have no idea, but they're great for Mercedes-Benz. And so that's essentially what you would have on a global basis, that sort of bidding for quote-unquote active US facilities.
And I guess if trade barriers are reduced, it's actually going to make it.
Yeah, it might, in that sense, it might make it easier, yeah, more global economy, make it even easier for stuff. Yeah.
But something like NAFTA, where we had people want to move stuff down to Mexico, and they go to Mexico and ship it across in the free trade zone.
Well, if we move toward a territorial system and out of our current system, then it would make it easier then people would move even more stuff to Mexico. So I think that's what you're implying, and I think it's correct. So let me put it this way. This is what an economist would call a second best problem. I have other names for it, but I mean, the fact is there is no optimal solution here. There is no best solution. It's a very difficult problem. To me, the criteria isn't whether we can have a perfect system, but whether we can have a system that's better than the one we have now. How would we know if we have a better system? Well, one is we should know whether we're encouraging more reinvestment in the U.S. The second is less money going to tax havens. A third is that U.S. firms are competitive in most countries that are real countries. And a fourth is that you raise some tax revenue. So those are probably four criteria and a fifth criteria would be that we can administrate the criteria, we can enforce this without having 50 years of tax litigation. So my proposal is pretty simple. I look to see in the OECD what the average marginal effective rate was for countries in the advanced industrial sector, excluding the U.S., and it turns out to be 17%. And if somebody told me it's actually slightly above 17%, that the number had to be 18% or 16%, I'm not going to disagree, but it's sort of what I call Wyden agrees with me, an intermediate rate. So if you had, he agrees that you need something like an intermediate rate. So what you say is, look, we have no more deferral. Deferral is over. But what we're going to say is we have a global total tax that has to be paid on foreign profits to U.S. companies of 17%. You can either pay it abroad or you can pay it to the U.S. So if you're in the UK and you're paying 21%, then you're above 17%, and you take that money and you bring it back to the U.S. and you pay no additional tax. So in that respect, it's a territorial system, but it's what I call a modified, restricted territorial system. Because if you manage to move money to Caymans at 0, then you're going to pay that 17% now. If you manage to move it to Ireland, which is a big issue, you're going to pay the 5% difference. If you manage to move it to Singapore at 7, you're going to pay the 8% difference. So this clearly allows a bulk of the U.S. profits to be reinvested in the U.S. without an additional tax, and clearly would encourage people to do that. Second of all, it is a strong deterrent against putting money in tax havens or low tax jurisdictions, because you're going to pay the total of 17% one way or another. And because of that, because you're going to pay this differential, you would raise money. How much money you would raise, that's a point of great controversy. I roughly estimate something in the 250 billion over 10 years, but if somebody told me that they have a different estimate, I can't say exactly what it would be. So the other thing that's good about this system is I don't try to distinguish between types of income, IP income and active income. To me, that whole row is just a state. And lastly, I don't peg it to the US statutory rate because I don't know what that's going to be. What are the big arguments against this? Well, probably the biggest argument against it is Ireland. People say we're not going to be, our companies wouldn't be competitive in Ireland because they're paying, everyone else is paying 12%, and our companies would have to pay 12 plus 5%. But this is where I go to your point is, if we look at France, which is a relatively territorial system, they charge you 5% when you bring money back as a rough proxy of the deductions that you took in France before you sent that IP and other stuff out. So I view, and I think in talking to a lot of companies, most companies would think if they could pay 5% and free up their business decisions from tax considerations and try to make the right business decision, kind of distorted one on tax, they would think that's not an unreasonable deal. And I think that that's sort of the nub of the political issue is, you know, what sort of repatriation fee, in a sense you may view it as, would be reasonable from the point of view of the companies and would raise a little revenue. You know, there are other problems with what I've proposed, and you know, I'm not trying to say that it's perfect because some people would still argue, well, you're paying 17% abroad and you're paying 35% here, and so there's still an incentive to move money abroad. Actually, in that respect, you got to look at the U.S. effective rate, which is about 25%. So in that sense, but there still is some incentive to say, well, should I put something abroad and pay 17% or UK 21% versus here 25%? So yes, there still is some incentive. But remember, what we have now is the choice is you can pay 35% in the US, or you can pay 0 or 7% abroad. So the answer is the incentive is much less. So I don't claim the system is perfect, but I think the idea of an intermediate rate is where we have to go. And it has to be based on a simple system that doesn't require us to segment these types of income because we can't do it intelligently. And I believe and I know we would raise revenue over this system. The only question is how much. We raise revenue in 3 respects. One is we raise revenue by eliminating deferral for all the money that's in tax havens and at low cost. The second is there are people who would make reasonable decisions to move money and pay the 5% from Ireland. And third of all, there is this $2 trillion that's over there already. And I think most people would agree that there needs to be some sort of grandfather scheme. Now, I think it was Watkins who proposed 20%. And I think that's probably too high a rate, given the fact that these executives reasonably rely on the current system. So it's not like they were violating the law. They weren't violating the law. They were taking advantage of something that everyone knew was happening. But I would like to see, and I've proposed something like 12% spread over 10 years. And why do I say that? 12% sounds high enough that the Democrats will go along, but the present value of 12% over 10 years probably, depending what discount rate you use, is more like 5 or 6%, and all the Republicans say 5 or 6% is okay. So I'm just trying to get there in a more politically palatable way. So if you put together the grandfather tax and what you would raise from these other things, my rough estimates is you could raise $400 billion over 10 years. And then if you took on, in the US forum, what I call the cats and dogs, things like corporate-owned life insurance, oil and gas depletion, jet planes, hedge funds, you probably could generate another $200 billion without, tearing down the walls. I mean, anyone who thinks that we're going to give up R&D credits, it's not enough. Or give up lower rates for manufacturing, it's just not in the cards. So roughly, I'm estimating that you could squeeze out $600 billion over 10 years, which would allow you to bring the U.S. rate down from 35 to 30. Now, of course, it would have been better to bring it down further. The question is, can you do it this one, 2/3 of that reduction is being financed by the multinationals, who then get the benefit of freeing up their business decisions. And 1/3 of it comes out of the least attractive corporate benefits politically on the U.S. side. So I think it's a reasonable deal, but I'm the first one to say, you know, that's a framework and people could argue for and against. The main thing is we cannot keep going the way we are going now. This money is building up at the rate of $300 or $400 billion a year, and it will accelerate. People will continue to do things like Pfizer. People realize now that there are companies, companies with $50 billion abroad that they can't use to buy U.S. companies or U.S. technologies. So guess what? If they see a technology in India or in Romania, they're inclined to buy it because they got all this money and they can't bring it back. The companies hate it. They hate it that they can't make intelligent business decisions based on the merits, and that they're being forced to say, well, what the hell? What am I going to do with all this money? Remember, that money is now being invested usually at about 1% or 2%, and there's another part of the tax law that says passive investments, you're taxed at 35%. So that's actually the least good place. But over time, people aren't going to say, gee, it's okay to have 1% on 50 billion. Our company's only worth 80 billion, but we got, 50 billion earning 1% after tax. People are going to start using that money. And what does it mean using it? It means going abroad, building more facilities abroad, more companies abroad, more things, and it just makes it worse and worse. So this is a problem. The only virtue you can say about this is not a zero-game sum problem. This is a problem that's so bad that it seems like we should be able to fix it and have a win-win for everybody. The system is terrible. I mean, you say, here's our system. Our system is the companies are theoretically taxed, but they actually aren't taxed. Their business decisions are highly distorted. And, by the way, Treasury's not making any money on it. Outside of that, it's a great system. So, let me stop there. Yes?
So, I think most of what you talked about was foreign income.
Right.
You also mentioned that most industrialized countries, the average tax rate for domestic sort of earnings, corporate earnings in most industrialized countries other than the U.S. is 17%.
That's the average marginal effect.
Marginal. So isn't the real sort of issue the fact that despite having a solution for foreign source income, the real issue that a U.S. corporation will still be at a marked disadvantage compared to their counterparts in any of these industrialized countries when the headline rate on domestic earnings is still at 35%, which means that they get 65 cents of the dollar to reinvest or to do whatever with, compared to 83 cents.
Well, if we get two different issues here. One is for foreign source earnings, how they compare, say, the 21% in the UK to the 17% they pay in the US for this. But if you're saying, well, should you put your operations in the US, then the effective rate, if you're putting your operation in the US, not bringing money back, is really the relevant comparison, and that's 25%. And that's partly the reason I want to bring the statutory rate from 35 to 30, because that hopefully would bring the effective rate down. But I'm totally in agreement with you. This doesn't make everybody equal. It makes the situation less disparate and less. It's better, but not perfect.
And in fact, to carry the point kind of further, and I recall seeing a chart which traced the proportion of corporate taxes as a percentage of total tax income in the U.S., and it showed it decline over the years from 30-odd% to 20-odd%.
Absolutely. Well, there are two things that are happening in the corporate tax. One is more and more people are going to LLCs, partnerships, S corps, so we're getting out of corporate form. And the second is people who are C corps cannot easily. There's now a big tax if you go from being a C corp to a partnership. So people don't do that. But there's this two-tiered system. The smaller companies that don't have much foreign profits, their average effective tax rate is say 30. The ones that do have a lot of foreign profits, their average effective rate is low, much lower, and some people argue 13 or 14%. Depends a lot, and it changes a lot by industry too. So we have, I think that's yet another reason why we need to solve this, because no new corporation, no new business would become a C Corp unless they needed pension money and venture capital money. That's a separate issue.
Let's presume that in January, you have a Republican House and a Republican Senate.
Well, I think January is the time, but I think it's for two reasons. One is that Paul Ryan becomes head of the House Ways and Means Committee, and he and Wyden work very well together. If you remember the Medicare proposal that Paul Ryan made, which was a voucher system, and it was well thought of on Republican circles, but really lambasted on the Democratic circles. And Wyden worked with Ryan and came up with this alternative. You can either have the voucher or the current system. That, I think, was a politically very clever intermediate compromise. And so these guys can clearly work together. They're both very smart, they're young, and they're creative. And they're in that 12-month period between elections where you could actually think of something going on. I think the Pfizer deal, and you can be sure that the Pfizer deal means that every corporation in the United States is now looking at an inversion. Goldman Sachs is now working overtime to produce inversion booklets for the Fortune 100. There's no doubt in my mind. But it turns out, as I said, it's a lot more complicated than you would think. So this puts a lot of pressure on the system. So I think the Senate doesn't have to go Republican to have this. I think that the Republicans are likely to pick up seats in the Senate, whether they'll be a majority or not. People are a lot smarter than I do in politics would know what the answer is. But I think it then comes down to the president, because the question is whether the president would think that some sort of intermediate system. For a while, if you follow the president's statements carefully, he actually said, after I wrote an article quite a long time ago, a few months later, I sent it to people at the White House. A few months later, in his State of the Union, and this may have been the State of the Union in 2012, he actually said the phrase global minimum tax. Of course, like most political documents, nobody explained it, it's just thrown out there. But that's sort of what, I'm talking about. He also said at that time that he thought corporate tax reform should be revenue neutral within its bounds, meaning that you can't just go and say, hey, I don't like the mortgage structure, I don't do this. But I would say in the last year, you're from Senator Lee's office, Senator, so you may know better than I do, but it seems like the more recent rhetoric is you got to raise revenue out of corporate tax reform. And that's been creeping in. It's not clear how much or where or what, but at one time, the White House was saying revenue neutral corporate tax reform, which, by the way, will be very difficult to achieve. But if we actually then have to raise revenue to lower rates, not in individuals or do other things. One thing, and you'll comment on this, is anyone who says to me on the Hill, comprehensive tax reform, I assume they mean nothing. They mean do nothing. That's what they really mean, do nothing. Because, if we could pull off corporate tax reform in a revenue neutral way in its own, it would be like major victory for the forces of tax reform in the world. But that will be very difficult. If we have to include individual tax reform, if we have to include raised revenue, I just don't see how we do it. I don't know, what do you think?
So as far as that goes, I think there's a difficulty in doing corporate in a silo as well, it's because so much business has, as you said earlier, migrated to the pass-through structure. So you come into a difficulty there for any type of
Well, it's a very valid point. That's part of the reason I'm trying to bring the US statutory rate down from 35 to 30. But your point is, since it's pass-through, then you want to bring the 39.6% rate down also. Is that what I understand?
Right, that's the difficulty, is you already have this existing disparity that exists, and it's, and, you know, there's some things that account for that in the code, but it just.
I would argue just two things. One is the best is the enemy of the good, and so maybe you ought to see this as a progress and a progression toward this. The second is, even though the individual rate is now higher than the corporate rate, those partnerships, LLCs, are only taxed once. Corporations are taxed twice. So even if you reduce the corporate rate to 30% and kept the individual rate at 39%, if you took into account that corporations pay a corporate tax and then their shareholders pay a tax on the dividends, 20%, most people would say that would roughly be about even. You know, so you just, it's not like we're starting off with a equal system. We're not. The corporate system is clearly at a big disadvantage because it pays that 35% every year. Corporations, as you may know, don't even get a special rate on capital gains. So they're paying the 35% every year or whatever they're paying, and individuals are paying, so whatever they're paying, you know, effective rates maybe, you know, and so even if individuals are paying effective rates of 32%, and corporations are paying effective rates of 25%, because corporations are being taxed twice, it's still, the system is still very biased in favor of S corps and all of them, et cetera. So I guess all I'm saying is I understand the politics of it, but in terms of the numbers, you'd have to reduce the corporate rate from 35 to 30 to even come close to parity with all of these pass-throughs. That's why people are going to pass-throughs. It's a better deal. So if you say you can't have corporate tax reform unless you bring down the individual rate, you're assuming that the individual who's running a business would then be paying a higher rate than the corporate shareholder, and I don't think that's true. You see what I'm saying?
Yeah, I don't think it's a necessary condition, but I would say that it is a consideration that weighs pretty heavily on a lot of factors.
Yeah. That's why I say I happen to think if you run the numbers, you can see how disadvantaged the corporations are over the pass-throughs. So then you have to have a differential to make that anywhere near parity. But my second argument is, how do you get the individual rate down? You know, let's start the process of getting rates down. We try to do it all at once. My concern is we get mired in the details of tax reform, because I can assure you it's taken me years to figure out how the foreign system works. And every time I see something, somebody points up a new curlicue here or there, and you know, this is a system that's very complex, and that's what scares me. Because once you get into individual rates, then people say, well, what about mortgage interest? What about this? You know, and, you know, whole groups of people who hate you now. Yes.
I just came back from 2 weeks in Dubai, helping a friend prepare to get down there. And basically, the business plan operates in the cloud with IBM and EMC doing all the work. His operating site is your cell phone. All he needs is a business license and a bank account to be in the country. So I would comment that the fluidity of revenue movement is going way up at a speed you can hardly believe. And so your time frame of resolution is very
well, I agree with you. I think that the more we keep on the system, the more incentive it is for people to take all of their foreign profits and move them to even lower tax jurisdictions, and to shift whatever intellectual capital they've developed in the U.S. and plant it abroad, and then license it. And so it's clear what's happening, and it's happening at an alarming rate. And we already have over half the profits of the Fortune 100 overseas, they're just going to increase. And of course, if all you can do is buy foreign companies with this money, or foreign technology, well, then it just goes further. So I agree with you, the dynamic here, time is not on our side, time's working against us. The only good thing about Pfizer is it's sort of, I've had this discussion, so people hear, but, we're just the tax nerds, So when Pfizer does this, people start to realize, hey, this isn't just a group of tax nerds, This is actually has a good chance of destroying, really hurting the U.S. economy. It's already hurting the U.S. economy, but it's accelerating. That's part of the reason that I'm scared of individual tax reform. We really need to solve this problem. This problem, we have lots of problems with taxes, but this problem of this money overseas is growing, and that money is, the companies hate it, and we're losing, we're not getting any tax revenue, and it's spiraling out of control. So I just plead, and I'll be glad to talk to your senator about why it's really necessary to move quicker rather than longer. I understand it's not easy to get anything done in Congress, but this is not a problem that's standing still. This is a problem that's getting a lot worse, and a lot more quickly. I'm sorry.
Alex, do you want to ask one last question?
Are there any examples of foreign countries, Germany, wherever, that have a corporate structure like we have with pass-throughs versus corporate entities?
Well, there are a lot of countries that do have pass-throughs and partnerships, but if what's happened around the world, except for Japan and now for France, is generally these corporate rates have been coming down dramatically. So if the corporate rate in the UK is 21%, then the difference with the individual rates, it's actually considerably lower than the top rate of individuals in the UK. So that this may illuminate the process there. I guess people feel that the corporation is still at a tremendous disadvantage. So it's okay to have individual rates that are higher. But the trend across the world is, let's say 20 years ago, there were a few systems like ours. Now there are almost none. I'm not saying that there isn't, but none of them. 20 years ago, 35% in the US wasn't so out of the question. Now, the only country that's close is Japan, 33%. I'm not saying that some Emirates that I don't even know of. So the whole trend, we've become an outlier. We've become an outlier on rate, an outlier on worldwide. And every other country has figured out how to lower its corporate rate and go to what I call a modified territorial system. One of the misconceptions is that all these other countries are pure territorial systems. They're not. If you look at UK and France, they have special rules for IP, special rules for investment income. They understand what they call mobile income. So there's no perfect answer here, but other countries have managed to come up to, in my view, to a much better balance between what the corporate rate is. And they have a territorial system, they have a lower, but it's a modified system, so they don't let anything move around, and then they come up with a lower rate. And of course, when you have a lower rate, you put a lot less pressure on the system for everybody to move out. If we had a corporate rate here of 21%, you wouldn't see everybody running to go out. And I think, and I'll end with this and say, the saddest thing I think here is if you start to look at all the investment banks who are advising these IPOs and these new companies, they're saying, don't incorporate in Delaware, don't incorporate in Utah, don't incorporate in California, incorporate in Ireland. Because remember, you guys all want to get bought out by the big companies. The big companies all have billions of dollars overseas that they can't use in the US. So you're in a preferred position in terms of getting bought out. So it's bad enough that we have this situation with the existing corporations. It's bad enough that we have all these people in Dubai moving there. Now, all these people who used to be in Cambridge and North Carolina, California, they're gonna decide, might as well be abroad because that's where all the money is stuck. So that seems like really, really bad dream, and that one that we should avoid.
What an optimistic note.
Well, the optimistic note is Congress, and you probably agree, the only reason Congress moves is when things get to, when the heat gets that hard. And I'm saying, that's why I'm optimistic about 2015. The heat is on here, and the dynamic is on. And so therefore, I think there is a chance of doing something. It's subject to the political ins and outs, which have to be, make everything, a tough go. But the pressure is on here. This is not a stable situation. This is getting much worse very quickly, and we're talking about really large amounts of money that really impact the U.S. economic growth. So I think people are going to start to say, we've really got to do something about this. And Camp, AUKUS, these are all intermediate proposals, a lot of other proposals. I'm not saying what's a perfect thing, but hopefully we'll be able to do something about it.
Well, hopefully too. Bob, every time I listen to you, I learn a ton of things. I am certainly no tax expert. I am trying to get in trouble with my own 1040. But this is a great topic and it feeds right into national security. I think you just laid out that
absolutely
pretty well. So I appreciate everybody coming today. I realize it's a tight little audience, but important topic and a good one. Maybe we can get something going on the Hill. You can reference, it'll be on the website tomorrow, so just pull it on up and please pass around to folks and let's give Bob a big hand.